Welcome to The Explainer. So, you're thinking about starting a business with a friend. That's awesome, right? But let's be real, the money side of things, it can get messy, fast. Today, we're going to break down the essential accounting rules for partnerships. Think of this as your practical guide to building a great business and keeping that friendship intact. Yeah, this is really the big question, isn't it? Because if you get this wrong, you're risking not just the business, but your friendship too. But hey, get it right, and you could build something amazing. So to make this all feel a bit more real, we're going to follow the story of two partners we've created, Samir and Yasmin, and see how they handle the financial journey of their new company, right from the very beginning. All right, so we're going to follow their journey in 5 key stages. We'll start with the basics. What even is a partnership? Then we'll look at how they create their rulebook. From there, it's all about managing the money, sharing the profits, and finally, tackling some of those special situations that always seem to pop up. Sound good? Let's dive in. Okay, first things first. Before Samir and Yasmin can even start dreaming about profits, they've got to understand exactly what they're signing up for. So what does it actually mean to be in a partnership, both legally and practically? This definition looks pretty simple, but man, every single word here matters. Sure, it's about an agreement and sharing profits, but look at that last part, acting for all. That is huge. It means one partner can make a decision that legally binds everybody else. We're talking about a massive level of trust and responsibility right there. Okay, so these are the 6 essential features. And you'll notice those last 2, they're the really heavy ones. Mutual agency, that's what we just talked about. One person's decision impacts everyone. And then there's unlimited liability. Whoa. This means if the business goes under and owes money, they can come after your personal assets. Your car, your house, it's all on the line. And that's exactly why you need that trust and a rock-solid set of rules from day one. All right, so Samir and Yasmin get the basics. They're in. But before they do anything else, they have to tackle probably the most important job of all, creating the rulebook. How do they get on the same page about everything before it has a chance to turn into a fight later? The answer is a partnership deed. Seriously, think of this thing as the constitution for their business. It's the one document that spells everything out. How much money did each person put in? How are we splitting the profits? What happens if one of us wants out? It's all in there. It's basically their financial roadmap. But what happens if they skip this step? They're excited, they just want to get started, so they rely on a handshake and a verbal agreement. This is where things can get really, really messy. Fast forward a year, they have their first major disagreement about money. Well, what happens then? What does the law say? And boom, here's the reality check. If you don't have a written deed, the law has its own set of rules that it just applies automatically. So Samir might have invested way more cash, but guess what? Profits get split equally. Yasmin might be working 80-hour weeks while Samir works 20. Doesn't matter, she's not getting a salary. The takeaway here couldn't be clearer. A verbal agreement is not good enough. You absolutely have to get it in writing. Okay, so our partners, Samir and Yasmin, did the smart thing. Their partnership deed is signed and sealed. Now what? Well, now they need a system to actually track each person's financial stake in the company, from their first investment to their cut of the profits. And the tool for that job is the capital account. And there are basically 2 ways you can go about this. The first is the fixed capital method. The best way to think about this is like having 2 bank accounts. You've got your main savings account that you never touch, and then you have your everyday checking account for all your transactions. Then there's the fluctuating capital method. This is more like having just one single account where everything, your initial investment, your salary, your withdrawals, all gets mixed together. One gives you clarity, the other gives you simplicity. It's a choice you have to make. All right, that's the theory, but let's see how this actually works. We're going to plug in some numbers for Samir and Yasmin and walk through their first year of business using both of these methods. So first up, let's look at the fixed method. See how clean this capital account is? It only shows their initial investment plus any extra capital they put in later. That's it. The main balance stays, well, fixed. It's not cluttered with all the day-to-day stuff. So where does all that day-to-day stuff go? It goes here, into the second account, the current account. This is for all the other activity, interest, salaries, their share of the profit, and any money they take out for personal use, which accountants just call drawings. See how this keeps their main investment totally separate? Okay, now let's switch gears to the fluctuating method. You can see right away, it's a lot simpler. It basically just takes everything from those last 2 tables and mashes it all into one account. And the name makes perfect sense, right? The final balance has fluctuated a ton from where it started because every single transaction hits this one account. All right, fast forward. A year's gone by, and Samir and Yasmin's business actually made a profit. That's awesome. But now comes the tricky part. You can't just take the money and run. They need a formal way to split it up, following the rules they set in their partnership deed. This is a huge step that separates a real business from just a hobby. And to do this, they use a special account. It's called the Profit and Loss Appropriation Account. Now, its name is a mouthful, but its job is simple. It doesn't calculate the profit. That's already been done. Its only job is to take that final number and show how it gets appropriated or, well, distributed among the partners. And the process is super logical. You start with a net profit number for the year. Then you handle all the little adjustments from your deed, paying out interest on capital, charging for drawings, things like that. Whatever is left over at the very end, that's the pot of money that actually gets split as profit. Check out this example. This company started with a net profit of almost $36,000. But, and this is a big but, before the partners got a single rupee of that, the firm had to pay out a salary, a commission, and interest on capital. After all of that was paid, only $12,000 was left. And that's the final amount that got split between them as their profit share. All right, let's get into a scenario that happens all the time in the real world. Imagine Samir and Yasmin's business is doing great, and they want to bring in a third partner. Let's call him Rahul. Rahul's got some amazing skills they need, but he's got a safe, stable job. He's nervous about making the leap. So how do they get him to join? Well, one way is to offer him a guarantee of profit. This is a really powerful move. It's basically a promise. They can say, look, Rahul, join us, and we personally guarantee that your share of the profit will be at least a certain amount. And if the business doesn't make enough for you to get that, we'll pay you the difference out of our own pockets. So let's walk through an example. We've got Mohit and Rohan, and they brought in Rahul with a guarantee. The business had a decent year, and when they did the math, Rahul's share of the profit came out to 40,000 rupees. But here's the thing. To get him to join, Mohit and Rohan had promised him a minimum of 50,000 rupees for the year. So now we have a problem. There's a 10,000 rupee shortfall. The big question is, where does that 10 grand come from? It can't just appear out of thin air. The answer is, it has to come from the people who made the promise, Mohit and Rohan. And this table shows you exactly how the math works out. That 10,000 rupee deficiency gets covered by Mohit and Rohan. They pay it out of their own shares in proportion to how they share profits with each other. In the end, Rahul gets his full 50,000, and Mohit and Rohan's shares are a little smaller. But notice, the total profit paid out by the business is exactly the same. So, after all that, what are the big takeaways from our little journey? It really comes down to these 4 key ideas. Number 1, a written partnership deed is non-negotiable. It's your foundation. 2, pick a capital account method that works for you, clarity or simplicity. 3, have a formal process for sharing profits. And 4, don't be afraid to use special agreements like guarantees as a tool to help you grow. But at the end of the day, all these rules, all these accounts, all these calculations, they're just tools. They're the framework. Their whole purpose is to create clarity, to prevent arguments, and to build a sense of fairness into the partnership. Because when you have that, it frees you up to focus on the one asset you can't put on a balance sheet, trust. And that's what really lets you build a great business together. Thanks for joining this